Hello and a warm welcome to another edition of Econoday Unplugged. It's Wednesday, the 9th of December 2020. Mark Penders stateside, and I'm Jeremy Hawkins here in London. Is a coming, but whether the same can be said of a post-Brexit trade deal, well, who knows? Anyway, with that in mind, we thought this week we could start in Europe, where the focus is very much on Brexit and, of course, the European Central Bank meeting on Thursday. Both outcomes will clearly be very important to how markets trade in 2021. So to the seemingly never-ending Brexit saga then. Well, surprise, surprise, we're still waiting. Plenty of talking in the last week, but little sign of any progress. Crucially, still major gaps over, well, the three issues which have been the problems for a long time now. Those being EU access to British fishing waters, state aid, the so-called level playing field, and how to police disputes over that and any other trade issues. Now we're just, 22 days away from the end of the current transition period, during which the UK has essentially been trading as if it were an EU member. So whatever happens now, we're really well into the end game. UK Prime Minister Boris Johnson will have dinner with European Commission President Ursula von der Leyen in Brussels this evening. That's Wednesday, something that's already been called Brexit's Last Supper. Both, though, will have to give concessions if the talks are to proceed, but both would also have to sell any compromises to national governments that may not be overly impressed. Already, some news coming out suggests that people should not be expecting too much from this meeting, rather just something which perhaps is sufficiently positive that the talks can continue over the next few days. Certainly, if it looks as if there's been no progress whatsoever, chances are European stock markets will open under pressure on Thursday morning. Both the euro and particular pound would likely be in for a rough ride as well, probably to the benefit of the dollar. I guess at this stage, it's just quickly worthwhile mentioning what if there is no deal. Well, in a nutshell, I mean, the UK and the EU would trade with each other on World Trade Organization rules, at least initially anyway. So both sides would impose tariffs on imported goods from across the channel, and potentially just as importantly, if not more so, especially at the outset, the whole process of trade between the two would be hampered by non-tariff barriers, notably lengthy checks on product standards. In fact, just today we heard that one of the major supermarkets in the UK has said it's been started precautionary stockpiling of food some while ago now. And it's got to be said that makes perfect sense, since UK ports have been reporting that they've been struggling to handle just existing workload due to too many layoffs being caused by the first round of the coronavirus lockdown. And that, of course, is before the Brexit proper has even started. So bottom line then is that a no deal would be bad for the UK and for continental Europe. But as I said earlier, expect the biggest hits probably to be to the UK economy and the pound.
And that would mean so a hit on the pound and also an equal hit on the euro?
I think, to be honest, it's going to be disproportionately bad for the UK. I mean, it's clearly bad for both economies, but at the end of the day, the share of UK exports going into the European Union, and indeed the share of imports coming out of the European Union, is much larger for the UK than it is for the European Union. So yes, for the European Union, its exports going into the UK will be hit by tariffs and these non-tariff barriers, but it's a much smaller percentage of European exports coming into the UK than is of UK exports, if I can get my teeth around it, going into Europe. So proportionately, you'd expect the pound to suffer more.
Can I ask you about the Irish border? Now, why isn't that agreement a sign of affability or whatever, that the two sides are coming together?
It is. I mean, perhaps I should just mention, as of yesterday, there was a joint UK-EU committee which looks at the implementation of the withdrawal agreement. So the actual Brexit deal itself, which was signed off over a year ago now. Now, the UK was been talking about putting through its so-called internal market bill, which strives to ensure that there is a free flow of goods and services around all UK markets. Now, of course, within the UK, we include Northern Ireland. The problem becomes then next year, when the UK leaves the European Union, but because everyone wants to keep no barrier between trade between Northern Ireland and Southern Ireland, Northern Ireland would effectively be trading as if it were part of the EU, which essentially means that the UK could send goods into the EU via Northern Ireland because there'd be no checks. Now, yesterday it looks as if there was an agreement over what they can do about sending these protocol regarding checks on borders and stuff of goods moving from Great Britain into Northern Ireland. It looks as if it means as a result that the risk to the Brexit withdrawal bill that the UK could actually ignore some of the original Northern Ireland protocol, which would be against international law, that looks now to be a non-issue. And certainly the view was yesterday, well, look, this has got to be good news for the actual deals. However, this is really something which is completely independent of the trade deal itself. This is much more to do with politics and whether or not the UK is actually going to break international law.
So what exactly happens now? What is that? The Irish Sea? Okay, so what happens there? I mean,
well, kind of, yeah. To be honest, I mean, I think there's discussion taking place in the UK House of Commons today about some of the details on this, which I must say I've not had a chance to go through completely yet, and indeed they're still coming out as we speak. But ostensibly, it does seem that there will be, as you mentioned, effectively a semi-border at least, which will be the Irish Sea. So the water between the Great Britain and Northern Ireland, the other part of the United Kingdom, which means that goods going into Northern Ireland destined for the European Union will have to face some kind of border checks either when they leave Great Britain or when they actually arrive in Northern Ireland, particularly probably at the likes of Belfast Airport and so on.
Well, what's going to happen? Why don't they just the risk of just displacing manufacturing into Northern Ireland?
Well, they're right about, because effectively Ireland will be trading as part of the the single European market, whereas the rest of Great Britain isn't part of it. So the European Union is a bit desperate to make sure that the UK does not get the advantage of being part of the single European market when it's not actually part of it. So it all starts effectively means trying to put a border where you can't have a border, or shouldn't have a border in the first place, or I suppose put it the other way around, saying try not to put a border when you do need a border. So it's going to be a case of compromises on both sides, but there is this general agreement that no one wants to see a renewed border between Southern Ireland and Northern Ireland for all the politics we've seen in the past.
It sounds like it's going to be a gentleman's agreement between.
Well, I think that's right. The question is, will either side be trusting the check put in by the UK or whoever it may be? So I mean, it'll be interesting to see how it evolves, but certainly, I mean, it is a step in the right direction, but it doesn't tell us what's going to come out of tonight's meeting, tonight's dinner between the EU president and the UK Prime Minister, or indeed whether or not we can actually get a Brexit trade deal through or not. I mean, if you remember, we've been talking about this for so long now, and it wasn't that long ago that supposedly the deadlines were back in October and then November, because if we do get an agreement, it's supposed to be ratified by all the various EU member parliaments,
including Hungary and Poland.
Well, including Hungary and Poland, yes, that's right at this stage. And I suppose actually that takes us on to one of the other issues which is worthwhile talking about concerning Europe, is where we stand on that at the moment. Now, I think as we mentioned last week, there's this big issue of this COVID rescue program that the European Commission is trying to put through for next year as part of the overall EU budget. And as things currently stand, we still have no agreement with Hungary and Poland actually signing off on this thing. So it seems that at the moment, at least the latest coming out of Brussels, is that a second package may be put together that actually omits Hungary and Poland, the two states say blocking the rescue package at the moment, such that it would really just cover the remaining 25 members, and Hungary and Poland would not have access to the COVID rescue funds. Now, that may or may not happen. And as we speak, there was a short while ago on the wires of some comments coming out of Germany, which currently holds the EU presidency, talking about the possibility that the law of standards, which is the big issue for the Poles and Hungarians, attached to the disbursement of the rescue funds, being watered down, so that perhaps they'd be prepared to sign off on it. Now, exactly what this means and how far they're prepared to go down the track of saying it doesn't really matter whether you abide by the rules of a democracy or not. We don't really know. But certainly if that doesn't happen and we were to see essentially the European Union sort of splitting with 25 members versus Poland and Hungary, putting together their own budget together and the other side being left alone, then it can't be good news for sort of the long-term stability of politics across the European Union. And I suppose by association, it's got to start raising fresh doubts as to whether or not the Eurozone itself can survive over the longer term.
And if those issues are raised, we would have selling of the periphery bonds?
So, yeah. If people start thinking of European unions falling apart in any shape or form, then all of a sudden it's going to be, the dollar may be looking a bit soft at the moment, but it could make all that back extremely quickly. Now, these are huge issues, clearly, and it's worthwhile, I think, remembering that when you look at the net beneficiaries from the EU budget, Poland and Hungary are two who fare extremely well. So really, they've got to be careful here. They don't actually end up, cutting their own throat by refusing to sign off on the budget, which ultimately would be extremely beneficial for them.
Now, when the ECB meeting's on Thursday, how does the ECB address these issues? Does it refer to them vaguely, or does it specifically cite these issues?
I'll tell you what, in footballing terms, I think the poor old ECB must be as sick as a parrot. The central bank has been banging the drum really throughout this year, but particularly ever since this COVID rescue package started to be put together, about the need for European fiscal policies, and particularly pan-European fiscal policy, to provide monetary policy with support. I mean, outside of the relaxation of national policies we've seen out of the likes of Germany, France and Spain and Italy in particular, there's been nothing really at the combined level. So it's really come down to the poor old ECB having to keep on pushing as far as it possibly can with regard to its own monetary policy tools. And it's expected to do the same again when we get to Thursday. I'd be very surprised if Christine Lagarde, the ECB president, doesn't come out and say she's at least disappointed, or at the very minimum stress just how vital it is that this COVID rescue package is put through. As it is, it comes into if it meets any kind of deadline, the main impact won't really be seen until at least the second half of next year. So they've really got to get on with this. Yeah.
And how would she address Brexit?
Brexit, I think there's not much she can do. It's kind of, we just take it or leave it. I mean, she doesn't have any power to say, well, look, I'm sure she wouldn't have wanted Brexit in the first place, because she realizes it's going to be bad for both economies. What she might well do is to look at the potential impact of a no Brexit trade deal on the euro. And that, I think, is something she will mention. Euro dollar as we speak, where are we? Trading around about the 121 level or so at the moment, which is above the levels we saw back in September, when the ECB started making noises to the effect that, okay, no, we don't have an exchange rate target, but the level of the euro does have implications for inflation in the eurozone. And it's pretty obvious at that stage, when euro is about 118, euro dollar is about 1.18. Now, it's pretty clear at that stage that the ECB were unhappy with that particular level. And of course, since then, we've seen Eurozone core inflation move to successive lows. It's a record 0.2% at the moment. So the last thing that ECB wants, when it's still trying to get inflation up, and bear in mind, its mandate is still ostensibly all about hitting its 2% or near 2% inflation target. The last thing it wants is a stronger euro, which weakens import prices and hence feeds through into domestic prices. But I think in terms of what they will do anyway, they kind of boxed in now. I think all the talk coming out of the ECB over the last several weeks, or really they laid the ground at the last meeting, is that they will do something on Thursday. I think the expectation now probably is that we'll see, there's no expectation still on interest rates. So the refi rate is expected to remain at 0. What's become really the benchmark interest rate, the deposit rate, which sets to floor to rates, is expected to remain at minus 0.5%. But what they will do almost certainly is to increase quantitative easing. Now, they got the different tools for this. They've got the asset purchase program, which is the original quantitative easing tool, which currently stands at 20 billion a month and is pretty well open-ended at this stage. They also have the PEP, the Pandemic Emergency Purchase Program, which currently stands at 1.35 trillion, and that's been the main quantitative easing tool they've been using over the last several months. Now, the thing to bear in mind here is that in addition to the asset purchase program, they announced a few months ago now this additional 120 billion so-called temporary envelope of asset purchases that will expire at the end of December. So in other words, if they don't do anything with quantitative easing, then we'll be seeing fewer asset sales next year anyway, just because the temporary envelope is going to be completed. So it's real guarantees that it will get some kind of increase in quantitative easing. But
they're going to extend the temporary envelope?
Well, I don't think they will. Well, they could do. They may introduce a new temporary envelope. But what I think is perhaps more likely is that, the hit from the loss of the temporary envelope will be more than made up for by what they do in the PEP. And I think the market expectation or consensus at the moment is probably for an increase of the PEP, so this emergency purchase program, around about 500 billion or so. So that would take it up to 1.85 trillion. Perhaps they could even take it up as high as 2 trillion. And that would be clearly a significant boost. In addition, yeah.
And that's a fixed amount, and the asset purchase program is unlimited or a monthly amount with an unlimited time frame?
Well, yeah, as it currently stands at the moment, the asset purchase program is fixed at 20 billion euros a month, it's open-ended essentially until they regard that the economy is doing well enough, etc., etc.
Are the securities that they purchase under these two programs different?
They're very small. Basically, anything which can be purchased under the asset purchase program is eligible in the PEP. But the PEP also includes some assets, some non-investment grade assets, including Greek bonds, which the asset purchase program doesn't include. So, and the other key thing about this, as you mentioned, the asset purchase program is a fixed quantity of purchases per month. The PEP, it just simply has a ceiling over a time frame. And within that, the ECB can do a lot one month if it thinks it's necessary, not do anything another month if it doesn't think it needs to. So it's much more flexible. But one thing I think they will do, just to rub this thing in, is that they'll make of the PEP. This is currently scheduled to last at least until mid-2021. Well, they'll probably say now it's going to be until at least the middle of 2022 or something like that, maybe perhaps to the end of 2022. So it's going to be a case of increasing quantitative easing per se, increasing the duration as well. And on top of that, it's clear from the way they've been talking about, that they're clearly worried about the economy. They hate the fact that inflation has been so far below target for so long. They're worried about all the COVID cases across Europe, which are coming down now, but they're coming down from record highs, and they are still very high. So they've got all that to worry about. And it does seem in particular that they're also concerned now about signs from their own lending surveys that banks are tightening their credit standards. And indeed, there's been some fall off in loan demand as well. So what they will do on top of the PEP and perhaps the APP is I suspect they extend this refinancing program, a so-called targeted longer-term refinancing operations, the TLTROs. They're currently due to end in June next year. Well, I expect them to be extended, I guess, for another 6 or 12 months there too.
And this is to provide lending?
I should say it's targeted, which is what they're after. At the end of the day, you can keep throwing money at these things, but you really want to throw it at the right places. So by targeted, what they're doing, it's essentially it's cheap lending for banks. So it's the ECB going to the banks and saying, well, look, we'll lend to you at a ridiculously low rate on the grounds that you go and on lend it into the private sector. And it means that depending upon the amount of lending they do, they can borrow from the ECB at the deposit rate, which is already at minus 0.5%, less an additional 50 basis points. So ostensibly, we can get these banks borrowing from the central bank at a rate of minus 1%. So it really is. You can see why it's been so popular since they launched it.
Question now, turning back to QE. You wrote an article on this the other day here in Econoday that I encourage the readers to listeners to read. You make the point that the yield curve is entirely the European yield curve is entirely below zero.
Yeah, out to at least
So
30
what?
years.
So I mean, additional asset purchases. What is this pushing on the string? I mean, what do they need to buy something else other than bonds?
It may be. I mean, to be honest, I think the answer to that is yes. I think it really is a case of a law of diminishing returns here. I think it's got to the stage now, if asset prices are going to do, additional asset purchase are going to do anything. Yes, I mean, may help to stop longer dated maturities from moving back up into positive territory and dampening down demand to the extent that it would do that. But if we're going to see them really push yields down any lower, then we probably need to see the shorter end of the yield curve going down further as well, which would mean reducing deposit rate perhaps down to -1% or something like that. There doesn't appear to be any interest in doing that. So I think this is really a case of just putting more money into the system, hoping that it will find its way into parts of the real economy, make sure at least the liquidity is there, with a view to just trying to keep things going. And I think it's worthwhile mentioning with regards to this PEP, as we stand at the moment, only around about half of the existing PEP has been used. So from a purely technical viewpoint, there's no pressure on the ECB to come out and raise the PEP anyway, bar this loss of the temporary envelope from the asset purchase program. Well, that doesn't take you that much closer to the current PEP ceiling anyway. So really, if they come out and announce an increase in the PEP and an extension of maturity, I think it's simply just more to do with the confidence factor of sending a message to the market. Well, look, we've got this socking great backstop in there now. So if things start going pear-shaped, then we've got what, $1 trillion or whatever it may be that we can use to start putting liquidity back into the system to make sure it flows around as well as it possibly can do. So I think as much as anything else, it's a confidence issue in this.
Let's turn to the Bank of Canada. You did that this morning. No action there. Tell us about the Bank of Canada QE. When did it start?
Well, QE's been going well. Again, they joined in with the pandemic folks. They weren't one of the first people to do it, but they've really got involved in it since the COVID issue became major. Having said which, unlike many other central banks, they've actually, the economy itself has got to be said has probably outperformed most expectations. Yes, it's been hit by COVID, but it hasn't been hit as aggressively as we saw, just last week from the employment report. Despite tighter COVID restrictions they've had to introduce over the last month or so, by and large, the economy is sort of doing okay, and the Bank of Canada mentioned that in its text today. So what they've actually done as of the October meeting, they were running at a minimum net asset purchase level of, where are we, 5 billion Canadian dollars a week. That was cut in October down to a minimum of 4 billion. Now, they didn't change that today, but I think if the economy can continue to do as it's doing at the moment and the vaccines rolled out next year and hopefully things look that much better, then we'll see QE being wound up in Canada probably rather before we see it being wound up in most other places, notably the likes of the UK and Europe. I don't know what your view is. I suppose going across to you, when do you think QE might finally be ended in terms of the US?
Oh, it's not. I don't think it's a topic of discussion. The idea of withdrawing stimulus is theoretical, and we do have to
Well,
be.
say withdrawing it. Well, actually, say reducing the amount of stimulus. So you're looking at monthly purchase, whatever, just gradually fading them out a little bit. So stimulus is still there, but it's not being increased.
Exactly. Yes, less stimulus, withdrawing stimulus, but it's not any time. Are they thinking about it? So I think that will be, and we do have to pay attention. A super sensitive moment in the markets.
Dare you be seen to be thinking about it? Is the
other
issue,
right? Yes, even dreaming about it. So but it's I think it's too far off. It's the same with the inflation. It's going in the wrong direction here. The PCE index went down a tenth or two in the core and the overall, and about 1.5%, a little bit below 1.5%, and that's not very good. And and that's really what they're going to be looking for. I think that they're going to allow employment to do whatever it can, and if the unemployment rate continues to improve, and hopefully it will, I don't think that that's going to be the signal they're looking at. I think that they're going to be trying to get inflation up because of their experience over the last dozen years, where employment went really low, 3.5%, and inflation just sat there below target. So they're going to, I think it's going to keep a lot of stimulus going until you can see that lift in this odd and mysterious lack of inflation. But you also have to cover next week. You have the Bank of England meeting, right? Also, a Swiss National Bank. I mean, we can't go on forever like this, but can you touch on those briefly?
Yeah, because they're quite, well, I say they're quite easy ones, obviously famous last words in these kind of markets. But I think for the Bank of England, I mean, they've only just introduced their last quantitative easing package. So I think it's a done deal that will be a short meeting. They won't have too much to say. And ditto really for the Swiss National Bank, as we've talked about in previous podcasts. For them, as much as anything else, it's about performance of the currency at the moment. And we're looking at Euro Swiss, which is their sort of a key benchmark. Well, that's well above the lows we saw when the Swiss National Bank was contemplating possibly another cut in interest rates, and certainly relatively aggressively intervening in the FX market, so selling Swiss francs and buying euros. Just putting something together for next week, looking at some of the net intervention levels. It seems as if the Swiss National Bank really since the middle of about November to early November, they've hardly done any intervention whatsoever. In fact, if anything, they've actually done it the other way around, so just buying a few Swiss francs to just to stabilize their FX reserves. So it does seem for both of those meetings next week that it's going to be a relatively quiet one for the Swiss, simply because the pressure's not on them at the moment, and for the Bank of England because they've done what they need to do for the time being. And talking of time being, we have been talking for probably rather a long time. Anything else you want to put in from your side before we wind this thing up?
No, I think we covered a lot of ground. I think that the general global economy is we have to talk about Chinese trade. I wanted to we had this enormous burst in Chinese exports. When did that come out? That came out Monday.
Yeah.
And that's what I've been pointing out or concerned about their lack of import growth. And I saw that in that report again, the low mid-single digit year-on-year comparison for imports, and I can't remember what the exports were, almost 20% maybe growth, somewhere in there. And
actually, exports, so looking in front of me, exports are up 46. These are total exports, so not just for US, but total exports are up 46.1%. Imports were up, where are we? As you say, 32.7%.
Okay, wait, hang on now. Wait a minute here. Okay, I'm looking at okay, so yeah, this came out at Chinese time or in the morning of Monday. Year-on-year growth for imports and 21.1% for exports.
Maybe dollars versus, I don't
these
know.
These are U.S. dollar terms, yeah, and this is the overall trade, and their monthly surplus is $75 billion US. Well, so they're doing very well, but they have to share the wealth here. They have to buy other people's goods too.
Well, I'll tell you what. One of the sort of political aspects of this was it's the fact that it would appear to be, at least in part, COVID related. In the sense that it would seem that of the whatever the size was, this hugely we saw in exports was in large measure due to sales of PPE, personal protective equipment, for protection against COVID. Which, if we go down the road that COVID started in China in the first place, they appear to be benefiting now from the problems elsewhere in the world. I'm not sure if I want to touch too much upon that.
No. Well, I had one last thing to say, and that was, and that's the one contrast to others.
Yeah, most definitely. Actually, I have one last thing to say as well, at least to ask you, since if you can answer this in perhaps 2 sentences.
Okay.
I saw was yet more talk about a fiscal stimulus package out before year end. Yay or nay?
Oh, I have to guess. Boy, after the employment report on Friday, that was very weak. I guess we should have to talk about this. It was a 245,000 increase. And remember, we were talking about the Beige Book last podcast, and it was coming out, and I was describing the Fed's assessment, and that's exactly what happened: low end employment growth. Well, after that, everyone was very conciliatory about the Republicans and the Democrats. That was Friday. and something was supposed to happen on Monday, and now a $900 billion deal that the Democrats were offering, and they were going to start at that, and now that has seems to have not made any progress. So, yeah, I would say no. I guess. I mean, unfortunately, I don't think there's the political will yet to come up with. But you're going to have the unemployment benefits rolling off at the end of this month, and that's going to be a critical problem. So, but the Republicans have to get on board before the new administration comes in, if there's going to be a deal. So,
bit like Brexit, watch this space. Well, I think that is enough politics for this week. So let us call it a day. We'll be back again next week. And in the interim, you can always keep up to date, as I'm sure you know by now, with all the key market moving days and events in Econoday's global economic calendar. Thanks very much for listening. Stay safe, and we'll see you next time. Bye for now.